Hello everyone, so my name is Sandra Cristina. I'm from Group 7 and I will be presenting our group answer for study case number 1. So what's the deal? The animation industry has been growing super fast lately because everyone wants higher quality animated content. Seeing this opportunity, Nova Animation Studio is considering an expansion plan to boost their production capacity and stay competitive globally. The expansion includes building a new studio, upgrading their equipment, and hiring more talented people. But here's the catch. The project need initial investment of 4 million. They estimate the project will bring in 675 per year for 16 years. To evaluate whether this is worth it, they're using a discount rate of 11%, which reflect the cost of capital and project risk. Now, the big question is this expansion a good idea? Let's bring it up. So let's talk about NPV, or net present value. And it's basically a way to figure out if the project will make or lose money. The formula looks like this, as you can see in this PowerPoint. NPV equal minus CF0 plus CFN, and mean years, divide 1 plus K is a discount rate, and to the power of n years. And it's a years. Okay. For example, NPV equal minus 4 million plus 675,000 divide 1 plus 0.11 to power of 1 and make it and do continuously until 16 years. Next. So when we crunch the number, the NPV comes out to 955,067.1. So it's positive. This means the project will add value to the company. Next, let's check out the PI, or profitability index. The PI tell us how much we're getting for our buck. It calculates like this. For this project, the PI equal 4,955,000 67.1 divide 4 million equal 1.239. PI above 1. So anything above 1 means the project is profitable. So with of 1.23, the expansion is definitely looking promising. Next, let's look at the internal rate of return. So the ERR, it's the rate where the NPV equals 0. In other words, it's the break-even point for the project. The formula is a bit tricky, but the key thing to remember is that a higher ERR is better. For the project, the ERR is 14.79479%. Since this is higher than the discount rate of 11%, it means the project is expected to give solid return on investment. So the analysis based on the analysis of 3 metrics: positive NPV. The NPV of 955,067.1 indicates that the project will add significant value to the company. PI above 1, the profitability index of 1.239 confirm that the project is profitable and generate more value than it costs. ERR above discount rate, the ERR of 14.79479%. It's higher than company discount rate of 11%, meaning the company offer a good return on investment. So what's the conclusion? The conclusion is given the positive PV, a PI greater than 1, and IRR that exceed the discount rate, Nova Animation Studio should process with the expansion. The financial metrics strongly suggest that the project expected to be profitable and add value to the company.
Good morning or afternoon, everyone. So I want to presentation about expansion of Velocity X Motor product line. Okay, here is the case that I worked on. Velocity X Motors is considering expanding its product line to include gas for skateboards. The project recorded an initial investment of 50,000 for a new equipment and an additional $50,000 in working capital. The project is expected to last for 10 years with estimated sales of 2,000 units per year at a price of $200 per unit. The variable cost per unit is 40,000 and the annual fixed cost is $160,000. The equipment will be depreciated over the project life using straight line depreciation with no salvage value. The tax rate is 34% and the recorded rate of return is 10%. Okay, based on this case, I was asked to calculate the net present value NBV of the project and determine whether it is financially feasible or not. Okay. Okay, so initial investment requirement. First, I calculate the total initial investment required. The cost of purchasing the equipment is $50,000 and the additional working capital is $50,000. So the total investment at year 0 is $50,000, which will be the starting cash outflow of the project. Okay, next. Annual cash flow year 1 until 9. Okay, so in this I calculate the annual net cash flow from year 1 to year 9. The expected annual sales are 2,000 units at $200 each, resulting in total revenue of $400,000. The variable cost is 2,000 units. X $40 and is $80,000. Fixed costs are for $160,000 and depreciation is $45,000 per year. After reducing costs and applying at 34% tax rate, the net income after tax is $75,900,000. Since depreciation is a non-cash expense, I added it back to get the total annual cash flow of $900,000. For each year from year 1 to 9. Okay, next slide. Cash flow in year 10. Okay, in year 10, the operational cash flow remains the same, is $129,000. Additional the working capital of $50,000 is recovered at the end of the project. So the total cash flow in year 10 is $179,900,000. Okay. And the last slide is NPV calculating and recommendation. Then I calculate the net present value by discounting all future cash flow using the return of 10%. The result of the NPV calculating is 292 155 3,000. Since the NPV is positive, this indicates that the project is expected to generate additional value for the company. Therefore, the project is considered financially feasible and recommended to proceed. Okay, and the conclusion is based on the overall cash flow analysis and the positive NPV result, this project is projected to be profitable and worth pursuing. Okay, maybe just this for me. Thank you for your attention.
Right now, I'm working on case 3, which is quantum tech solution. So quantum tech solution is considering to build a new production facility. They were trying to expand their production capacity so they can increasing their revenue and then getting more profits from it. So quantum tech solutions need an analysis of how much do they have to sell units to reach break-even point. So first of all, they got the total of initial investment for 800 million yen, and then also they got the price per unit for 15,000 yen, and then their variable cost for 10,000 yen and fixed salary around $1,800,000. 1800,000 yen. Sorry. Okay. So first of all, when we are trying to calculate the total of units they need to reach a break-even point, is we need to calculate the total of fixed cost, which is first we got the fixed salary around 1800 million yen, and also we got the depreciation value from the initial investment for the factory they are building. So because they were using straight line method, which is the total value that the factory they are building I'm sorry. So the depreciation over 5 years using straight line method, we're just gonna divide the total initial investment with the total of years they are using for the machine. So we got 1600 million yen. So the total of fixed cost is around 3,400 million yen. And then we're just gonna divide the total fixed cost price minus the variable cost, and then we got this the units that we need to reach quality. The total of unit that we need to reach for the break-even point. Total revenue of around 1 billion yen, and also the total cost is around 1 billion yen, and the fixed cost is 3,400 million yen. So this is where the break-even point. This is where how much units they need to sell to reach the break-even point, and this is the total of sales that they need to do so they get the break-even point. First of all, for the strategic recommendation, considering the market trends and also the market needs, and this is probably the analysis for the decision. So the break-even point of 68,000 units with total sales break-even of 1 billion yen must be compared with the expected market demand. So actually, the market demands for memory cards is quite good, and they were surging from approximately $17 billion in 2022, and it's still growing, and we were expecting to reach around 24 billion by 2032. So based on the trend, I think quantum tech should proceed with the expansion. Potential risks that we should consider. First of all, the high initial investment is quite high, like 80, like 800 million yen is quite significant upfront cost. If the cells underperform, it will lead to long-term financial strain. Therefore, it's gonna be financial issue for quantum tech. So, and then the second, there's pricing pressure and competition. We know that there's competition in this market is quite competitive. It's highly competitive because there's so many factory and manufacturer from US that are dominating the market, like SanDisk and then Lexar. So Quantum Tech might face some price war from larger brands or cheaper imports. So the last one that the Quantum Tech solution should consider is production risk, because they are setting up a new facility involving operational and logistic. It might faces some challenge like delays, quality control, and unexpected cost. So I guess
The fourth case. Okay. So Nexatech Solution is a leading semiconductor manufacturer in South Korea, and they are planning to acquire new high-speed precision equipment to enhance their production, and they have two options to financing this equipment. The first one is by loan option, and the second one is lease option. So with the loan option, they want to obtain a medium-term loan of 250 million won with the 6-year term, and annual interest rate is 9%. And this loan will be used to purchase the required equipment at an acquisition cost of 250 million won. The equipment is expected to have a residual value of 30 million won, and the tax rate is 35%. While the lease option, company can enter into a 6-year lease, and the annual lease payment will be 52 million for 6 years, and the lease payments are tax deductible. Okay, the first one will be loan analysis. So we already know that the loan is 250 million won. The interest rate is 9%, the time period is 6. And the residual value is 30 million won, and the tax rate is 35%. So the first one, we will calculate the annual depreciation. So to get the depreciation is the loan minus the residual value, divide the time period, which is 6, and this is the result. This is the depreciation. So 36,666,667. And the second one is after tax cost of debt. You can get this by interest times 1 minus tax rate. The interest is 9% and the tax rate is 35%. And this is the result. 0.0585, and we can change it into percentage, which is 5.85%. So, and then assumption A, loan payment are made at the beginning of the year, and this is the formula. So loan sigma n minus 1 t equal to 0, loan payment divide 1 plus interest, and then square t. And the loan is 250 million, like we already know before, and the loan payment is still loan payment because that is the variable that we are looking for. Divide 1 plus 0.09. Then we change into like this. So the loan payment times P5 9% 0 time period plus loan payment times P5 9% 5 time period. So why it's 5 not 6? Because the other one is this one, because it's the payment is beginning of the year, and then the P5 for 9% time period 0 is 1, and the P5 is 3.8897, and then we add it up like usual. It's going to be 4.8897, and then we move to the left side, divide, so 250 million divide 4.8897, and this is the result for loan payment. Then we continue to schedule of debt payment. So we have end of year 0, 1, 2, 3, 4, 5. We start from 0 because the payment made from beginning of the year, and just the loan payment, the interest, and the end of year 0 don't have interest. And to get this remaining balance, it's 250 million won, the loan that the company took minus loan payment, and the principal repayment is get from loan payment minus interest, so it's 51 million minus 0, and here it is. And for this one, it's remaining balance times the 9%. Now it's schedule of cash outflow. We have the loan payment is still the same, and then we have interest, depreciation, tax shield, cash outflow after tax, PVIF, and then PV of cash outflow. The PVIF we use 5.85% because we use it from the from this one, from the after tax cost of debt. Okay, so we continue. So and the interest from the previous table, from this one, and the depreciation also from the one that we already calculated before, and then the tax shield is from interest plus depreciation times 35%, and the cash outflow after tax we get it from loan payment minus tax shield, and then the PVIF is from the PVIF, and the PV of cash outflow is from cash outflow after tax times the PVIF. So it's like 32 million times 0.9447 and 30 million is the result. And then for the total, we add up all from end of year 0 until end of year 6. And then the reason why there are two end of year 6 because the first one, because we still have the depreciation and the tax shield. And the second one because we have residual value, which is 30 million. Okay, so and the total is 172,728,031. And then we move on to assumption B. Loan payment are made at the end of the year. And this is the formula. So 250 million loan payment times PFIFA 9% 6 time period. And the PFIFA is 4.4859. And then we did it before we moved to the left side, so 250 million divide 4.4859. And this is the result, 55,730,177. This is the loan payment that made at the end of the year. This is the schedule of that payment. It's the same like we used before. This is the interest, loan payment, principal repayment, and remaining balance. Then we have the schedule of cash outflow and the interest. I forgot to explain that the interest, like the same like this one, the interest you get it from this one. So it's the same for this one, and the result is 172,733,437. That's the present value of cash outflow for the loan that payment are made at the end of the year, not the beginning. And then we have depreciation benefit. So we can get it from tax shield equal annual depreciation times tax rate, 36 million times 35%, and this is the tax shield per year times 6. So if the company choose to own the equipment, the company will save 999,998 won in taxes due to depreciation. And then the second option is the lease option. This is the analysis. We know the lease payment is 52 million, time period is 6, tax rate is 35%. So the after-tax cost of lease, we can get it from annual lease payment times 1 minus tax rate times PFIFA 9%, time period 6. And this is the result, 151,623,420. So it means that after considering the tax savings from the lease payments being tax deductible, the real cost of the lease to the company is this number. Okay. So assumption A, lease payment are made at the beginning of the year. This is the schedule of cash outflow. So if end of year 0, 1 until 5, and then 6, this is the lease payment, 52 million. And the tax shields is known because it's the first year. And this is the PFIF and PFIFA. Okay. And then the total for cash outflow for the lease payment that are made at the beginning of the year is 186 to 160. And then the assumption B, lease payment are made at the end of the year. And the result is 171,558,660. So the final recommendation is the lease option with payments at the end of each year offers the lowest cost and highest benefit with the present value of cash outflows of 171,558,660 won. So before making a final decision, the company should consider financial risks such as potential cash flow constraints. So company have to make sure that they have enough and consistent of cash flow annually, so it won't mess up with the calculation we did before. And if the company needs change and the asset is no longer needed to become outdated, so let's say if suddenly in the third year or fourth year there are a better machine and the company want to change it, then it's a risk for the company that they have to consider. So that's all from my explanation for the fourth case. Thank you.